When the stock market goes on sale, we like to talk about doing some R&R. And no, we don't mean rest and relaxation. We mean rebalance and Roth conversion. Here's the reality. We like to say the market's either at all-time highs, which it is most of the time, by the way, or we're in a temporary drawdown. Now, every 10 years or so, we're going to get a major shock to the system, a 40 to 50% drop or more off the prior market highs. Now, in these moments, what happens? Amateur investors panic. They panic sell and go to cash, often never getting back into the market. As a reminder, temporary drawdowns are only made permanent with foolish behavior. What about good investors? They know to stay the course. They know not to react. How about great investors? What do? They actually get excited and lean in. They see these rare once-a-decade downturns as a chance to buy the great companies of America and the world at a substantial discount. And in our case, we love using market volatility to create long-term tax-free wealth for our clients with opportunistic Roth conversions. Now, how do we do that? Because when the market recovers back to all-time highs, as it always has historically, the growth and the bounce back inside the Roth is all tax-free. When headlines are screaming negativity and the markets are plunging, we want to be dollar cost averaging the whole way down with Roth conversions. I always say invest like an optimist, but pay your taxes like a pessimist. Let's look at a simple example to show how powerful this can be. Scenario number 1, converting at market highs. An investor has $1 million in a traditional IRA or 401k, but as a reminder, they don't really own all of that. Uncle Sam owns about 30% or $300,000 because of income taxes. They go ahead and convert the full $1 million to Roth, and they owe $300,000 in taxes. The market then drops 50% like it did in 2008. The Roth IRA falls from $1 million to $500,000, but eventually the market recovers and goes on to set new highs and grows to $1.5 million. What is the result? $500,000 in tax-free growth. They had to ride the roller coaster of the market, but they made $500,000 of tax-free growth. Not a bad scenario. Scenario number 2, though, converting in the downturn. This investor waits and the market gets cut in half, so their $1 million IRA is now only worth $500,000. They then do the Roth conversion. Well, values are down by half. They only have to pay tax on $500,000. That's a $150,000 tax bill instead of $300,000. The market rebounds and grows to $1.5 million, just like in scenario number 1. But this time, the investor got $1 million of tax-free growth and paid half the tax to get there. That is the power of opportunistic Roth conversions. At Brandywine Oak, we help our clients see these inevitable market dips not as threats, but as opportunities. To learn more about how we can help you take advantage of volatility, not fear it, scan the QR code or give us a call to get started.